This is the third in a four-part series of resources that considers the financial statements companies are expected to create as part of the generally accepted accounting practices. Part 1 provides an overview of the three statements and suggests the reason for creating them. Parts 2, 3, and 4 focus on the individual statements. We define each and explain what types of transactions and information are provided on each. Income statements answer the one question companies worry about. Did we make any money? It will consider all money and other resources that come under the company's control and subtracts away any spending or other obligations that take away resources. The income statement considers these actions over a period of time. While the balance sheet provides a snapshot as of one particular moment in time, the income statement considers all the actions over a period of time and provides an ending date. As the cartoon suggests, the income statement identifies whether the company made a profit or endured a loss. This gives a manager or CEO the bottom line on the operations of the company. Now that we have a general idea about the purpose for an income statement, let's consider the information contained in this financial statement. Revenue is anything that will cause an increase in a company's assets. Revenues are usually created by selling their goods or providing services. So a grocery store selling its stock or a hairdresser doing a haircut would be methods for those companies to create revenue. In particular, the assets that get increased are either cash, if payment occurs at the time of the sale or service, or accounts receivable if the customer pays on credit. Note that the revenue must be free of any liability. For example, suppose you pay a contractor to put a new roof on your house. You pay a down payment. Because the roof has not actually been installed, this down payment is actually a liability, and the contractor cannot claim the down payment as revenue. We will consider how and when exactly the payment becomes revenue in a later resource. Also, it is possible for a company to gain cash, but that transaction may not be a revenue. Consider a company that takes out a loan. The amount of available cash does increase, but that loan has to be paid back. Therefore, those funds are actually a liability, not a source of revenue. An expense is the opposite of a revenue. Expenses consume assets. However, expenses are not always strictly money or promises of money. Salaries and utilities are expenses for a company because it does indeed lower the quantity of cash. Not all expenses are as obvious, however. When a company sells some of their inventory, they place some of their assets out of their control. This is exactly the definition of an expense. As such, that portion of their inventory sold becomes the expense, cost of goods sold. As with revenue, some transactions can be a little tricky to classify. What happens if a company buys some office supplies? Yes, the amount of cash assets is lowered, but it is being transferred into another asset, supplies. So how can we find the bottom line for the profit of a company? As mentioned earlier, the largest concern of most members of management is the bottom line, whether or not the company is making money. On an income statement, this bottom line is literally the bottom line. Net income, or net loss if the amount is negative, is located at the very bottom of the form. The method for finding this net amount is to subtract the total of all revenues minus the total of all the different expenses for the company. Finding this quantity is broken down into various steps. Some of these subtotal amounts are also important indicators of the financial health of the company. One such important subtotal is the gross margin. Gross margin is the difference of sales minus the cost of goods sold. In other words, the gross margin shows how much money is made by the company in doing what the company is in business to do. Wait, there are other ways for a company to make or lose money? Sometimes a company can earn or lose money in activities that they are not specifically in business to do. Operating revenues and expenses come from the primary business activities of a company. Otherwise, revenues or expenses are referred to as non-operating if they exist outside the primary business activities. These non-operating earnings or losses are called gains or losses. As an example, consider a newspaper. Their operating revenues would include any subscriptions or advertising. However, the newspaper may also make money by selling an old delivery truck. The cash gained would be accounted for as a gain on the income statement. Let's take a look at an example of an income statement. This is a very basic income statement. We see that the revenue comes from sales. Then the company considers its operating expenses in the form of cost of goods sold, broken down into some additional categories: materials, labor, and overhead. Subtracting sales minus the cost of goods sold gives us the gross margin. Then the company lists its other operating expenses: selling expense, administrative expenses, and depreciation and amortization. Subtracting those expenses from the gross margin gives the operating profit. Then the company considers its non-operating income interest, non-operating interest expense, and also some extraordinary items. This provides the income before taxes. They then determine their income tax and subtract. This leaves them with their bottom line, when they found that they had a net income of $4,225,000. Personally, I'd be pretty happy with that amount of profit.